Welcome to Your Money, Your Retirement, Your Life, the show that helps you make the most of all three. Hosted by Drew Pelton of Drew Pelton Investment Services, where the focus is income first, growth second, and your goals always.
It's your money. It's your retirement. It's your life. Yes, it is. Thanks for being with me this morning. I'm your host, Drew Pelton. I've got some good and great news. I have good and great updates. I have great developments I'll share. But before I do want to say, it is all about you. It is all about you. It is all about you and your family. It's all about you, your money, your retirement, and your life. And I want you to truly embrace that sentiment. That is why I have titled my book, Your Money, Your Retirement, Your Life. And that is why I am renaming this radio show to Your Money, Your Retirement, Your Life! Exclamation mark. Where did that come from? It came from the fact that I saw too often, whether obviously, directly, indirectly, openly, understandably, not understandably, I found too often the people we were talking with, and sometimes even our clients, particularly early on, but after a while, clients normally understand that we want them and need them for them to embrace that sentiment. I know I do as a fiduciary. I know that I think of whoever we're talking with, and I think of whoever might be our clients or whoever actually become our clients, or if I'm just talking on this radio show to help you to be a good educator and informer, I want you, for your sake, to embrace this sentiment. It is your money. It is your retirement. It is your life. And I am confident after 45 years of being in the financial services, investment planning, retirement planning, estate planning, world business, this world and business of helping people have a safe and secure retirement, that too many people don't emphatically embrace this sentiment, and that is effectively the beginning of what could be problems, because from that, not embracing it's your money, your retirement, your life, starts to come not good decision making, or in many cases, just simply not making decisions. The fact is, as Vince Lombardi said, winning isn't everything, it's the only thing. And the fact is, on a positive note, don't you think that any winning LSU team, and obviously the latest here is our men's baseball team, thank goodness, don't you think they said, we can, we will, we're going to win, we deserve to win, we've been working hard, we've got the talent, it's our baseball team, it's our year again, and we can and we will do this. That is the sentiments, and that is the voice of winners. In any sports team, that's the way it goes. And sometimes there are teams saying that and they don't win the championship, and I understand. But if you don't win the last game, if you don't win the championship, if you don't win the World Series, if you don't win the Super Bowl or the NBA championship, but you went as far as you could go, that's better than you not even playing, because there's too many people in retirement that are just being soft or not being as focused as they need to be. And that might be you. I know that when you embrace that, you really truly embrace that thinking, that you are going to begin to have a winning championship mentality that I believe should get you to start thinking more exactly as to what really needs to happen in your retirement and your retirement investing. Successful retirement investing is something that's different than just cookie cutter, something that's different than disease of ease, something that's different than, oh, I know my guy for 25 years. Something's different than for those of you that are do-it-yourselfers. And if you are embracing, it's my money, it's my retirement, it's my life, and you want to talk with us about making sure that your monies are stable and secure, and you want to do the right things for you, give us a call and we're happy to talk with you. All right. So we're going to be talking about the importance of process and planning versus product buying or selling. And you don't want to miss it, because you want to understand what you need to do and what works and what works best. All right. Stay tuned. I'll be right back. You're listening to Your Money, Your Retirement, Your Life. I'm your host, Drew Pelton. I'll be right back.
Your money, your retirement, your life. The show that helps you make the most of all three.
All right. Welcome back. You're listening to Your Money, Your Retirement, Your Life. Your money, your retirement, your life is the sentiment you want to have to begin with in order to embrace what you need to embrace relative to doing good planning through a process so that you can get to a place where your investments are working for you. Because as the title of this particular show, Retirement Investing Success, implies, you need to do things that truly are about retirement investing success. And many people are thinking that they can do the same kind of cookie cutter things they did when they were accumulating money. They think that, oh, well, I would just invest in mutual funds and I have an allocation and I change my allocation from 80% stock funds to 20% bond funds, or I should say 80% stock funds and 20% bond funds. To the first percentage I'm going to use is stock funds and the second bond funds, but you know what I'm saying, I believe 80-20, and then you get a little closer to retirement, or you're a little concerned about markets and you go 70-30, you go 60-40, and then maybe you are retired and you think, oh, I'll go 40-60. And the fact is these cookie cutter types of approaches aren't the specific things to help you get income. You need high yields, high dividends, high interest to allow yourselves to get income from income, because it needs to be about income from income. Get income from income. It is all about investing for income, but with a balance of growth. So we've made some adjustments where we are enhancing our offerings so that everybody can understand that, first of all, from an educational perspective, that you need to have a robust balance in what you're doing in investing. But the key thing is to make sure that you are investing for success by investing for high yields, high dividends. I always talk about the triple advantage. I call it the triple advantage. I don't know that anybody else has called it that. Not that they couldn't, but I believe I'm the first one that said it. At least I don't remember anybody else saying it. But I call the triple advantage the benefits and the necessity of having a balance of preservation, growth, and income from your investments. There's too many people invested in a way where there's so much risk and volatility that there is a good chance they may not have the preservation. Additionally, there's many people that are invested in a way where they're not getting the growth they need because maybe they're either too conservative or they don't realize that 80-90% of mutual funds underperform the S&P 500 index. Or many people have been sold down the river with not the best annuities, where the annuities are not performing well, and the returns aren't even keeping up with inflation, and they're just not structured right or getting the returns that people need for the long term in their retirement. One of the things I'm going to talk about in just a little bit is that one of the industries or one of the areas that you should be aware of that one could be investing in where there's so many advancements is healthcare, because there's so much technology, and with the dawning, so to speak, I mean, it's not new, but it's still new, relatively speaking, meaning AI, artificial intelligence. But with all the new technologies that are coming forth, there's many great things that are going to happen within the world of healthcare and medical advancements that more than likely, and I would say highly probable, people are going to be living longer, because the advancements are going to help people stay healthier and stay alive longer and stay alive longer in a healthy fashion. So that is one of the industries that you want to keep your eye out on. Now, I'm going to talk about that in just a second, because there's some interconnectivity between a couple of things for the future. One of the things that we are doing at my firm is we are wanting to keep our eyes and ears open for what is new, what is modern. There's a lot of in the box. There's a lot of get stuck, stay stuck in old ways that don't consider the realities of what's going on. I just gave one, AI is one. I mean, do you remember, to make a point, what it was like in the early 90s or mid 90s, and maybe you didn't get on board with respect to technology? Now, of course, in the year 2000, we had a serious crash, .com crash and technology crash. But the reality is that the dawning of the internet and all the technology that went on over the course of time in the long run ended up being a driving force in our economy. And when people were invested properly in a balanced way, where you didn't necessarily put all your eggs in one basket, there were ways that an investor could actually take advantage of that. We as people, just generally as American people, or just generally as any person on the face of the earth, we have a tendency to get stuck. We have a tendency to not keep up with the times. We have a tendency to not follow the economic trends. And part of that is human nature, but the other part of it is the fact that many people just don't understand investments. They don't understand trends, and it's difficult. So not to keep up with those things is a little bit of you not understanding your money, your retirement, and your life, and how to be modern. You want to modernize your portfolio. You want to modernize your investment approach. And you want to have, I believe most would say, the triple advantage. What is that triple advantage again? Preservation and stability, number one. Growth in a reasonable, moderate way, two. And I'll put a little parenthesis there, without having to take significant risk where there may be high risk and volatility and high losses. There's ways to balance that out. So one is preservation and stability, two is growth, and three is income, where your income or your dividends and or your interest from your investment allows you to get income from income. That is an objective that I call the triple advantage. And to be successful, you want to have fundamentally that triple advantage. Now, let me share with you some things about planning and process. Typical Drew Pelton 101. Take 10 minutes to get to the thing I said I was going to get to. So forgive me. So, I think about all these support things, but, I mean, I think it's pretty easy. I'm taking my glasses off for those of you that can see me on the podcast so I can read better. That's how it works for me. So we believe that it's best when people go through a process rather than they get slam dunked, so to speak, after going to a seminar or workshop, and then you go into somebody's office and in 2.5 minutes or whatever it is, or after 5 minutes of some niceties, they're going, oh yeah, well, we've got these products and you're going to be safe and secure, and you're getting slam dunked into a product. I see this as number one. I see it as 4 things. Number one, your goals, objectives, needs, wants, and desires need to be defined. So number one, define your goals, needs, and desires very clearly. You really need somebody to help you bring that out. Because, some people might say, well, I just want to have enough money. Well, yes, but the talking and the thinking and the planning about that and getting that very specific and putting some numbers to those goals and objectives is critically important. So that's number one, define your goals and objectives and your needs. Okay. Number 2, you need to be working with somebody that has an expert planning process to take you through this whole process. I just mentioned the first part of that process should be about identifying your goals and objectives, but there's a process and a smart fiduciary process that you should be taken through. And it doesn't take 5 or 10 minutes. I mean, it doesn't necessarily need to take, one meeting. In a lot of cases, I find as I've worked with people over the course of time, it's 2-3 meetings at least. And that's normal, and most people are more comfortable with that. So number 2 is expert planning and in an expert planning process. Number 3 is allocation selections done by way of a fiduciary tutorial allocation way, and where it's truly fiduciary is in your best interest, where it's a tutorial educational approach, and where the allocations are ones that you pick and choose. The 4th thing, effectively it's the result of the first 3, is that you get a customized, tailored plan for you for high results, for high effectiveness. Process and planning, a process with a good planning, with good planners helps you get to where you want. And you need somebody that isn't trying to sell just their agenda. You need to be working with a team that understands the universe of choices and can help you understand what's good and right for you, as opposed to, again, just getting slam dunked into investments. And typically those slam dunking things that I see are mutual fund allocations, maybe include some exchange traded funds, and those allocations tend to be very cookie cutter. Very often they're high risk. I see so many people that have investments that are not in sync with, I'll just say, the rule of 100. Has anyone ever heard of the rule of 100? And I want to say quickly, it's more to me a guideline, but there's a rule or guideline called the rule of 100 that says if you take your age and subtract it from 100, so take your age. I know everybody listening in is only 39 years of age, so you can use that. But if you do use that, it's probably not going to be realistic to the situation at hand, which is you're probably not 39. But in any case, forgive my levity on a serious point here. But let's say you're 70 years of age, whatever your age is, 60, 65, 70, 75. So I'll just take 70. So if you subtract 70, if that was your age, from 100, you would be left with what? 30. 30 would represent the percentage, the maximum percentage that you may want to have at risk in financial markets. So it's a guideline. It's just like the guideline and the rule of 72 that tells you how fast you can double your money. If you get 7.2% interest, you divide, the way you figure it out is you divide 7.2% into 72, you get 10, and that is the way the math works, is if that happened and you didn't take any money out, that you would double your money in 10 years by way of compounded interest. So some of these math rules can help you think about things, and you want to be thinking about these things so that you can make the good and right and best decisions for you. What's the bottom line message here? The bottom line message is planning through a process where it is about you, where it's truly a process where you're thinking it's your money, your retirement, your life, and the advisor is truly thinking it's your money, your retirement, your life, and where both of you understand that, and where the advisor is truly experienced and knows what they are doing. Because there's too many financial advisors that are more product salesmen than anything. They pass a test, they get a product, and they start talking. And that talking turns into eloquent speech and buzzwords, and the eloquent speech and buzzwords turns into you buying something that somebody sold, and it may have some benefits. I'm sure it probably has some benefits, but the question is it truly good and right for you for the long run to help you do what you need? Because don't you want, one, peace of mind, confidence, comfort in what you're doing? And don't you want to make sure that your money is stable, preserved, is growing, and you can get income from income without invading principal, right? Pretty fundamental, pretty basic, but how many of you are really doing it? All right, I want to thank you for being part of this show. Your money, your retirement, and your life. We're rebranding ourselves. I'm doing it based upon my book, and I'm doing it because it's the message. It's the message you want to embrace. All right, stay tuned. And I'm going to be talking about 12 places that the wealthy invest their monies. And this survey was taken by way of the tax returns that a very successful CPA firm in America conducted through their own high net worth wealthy clients. All right, so I'm going to share that with you when I come back in this third segment. All right, stay tuned. I'll be right back.
Your money, your retirement, your life. It's not just your money, it's your retirement and your life.
Welcome back, or thanks for joining me. You're listening to Your Money, Your Retirement, Your Life radio show and podcast. I'm your host, Drew Pelton. Thanks for being with me. Today, I am talking about retirement investing success. And you want to be strong, and you want to be a champion, and you want to embrace your money, your retirement, and your life in a way where you make good and great decisions for you, where you have the peace of mind, comfort, and confidence, where you can go the distance, and that takes smart investing. One of the things that we try to do is keep our eyes and ears open, generally speaking, but more specifically, where we are doing research and we understand economic trends, where we're following the times. And in order to do that, it takes sometimes not just following the cookie cutter things that people do. What do you think the cookie cutter things are that people do? I think the two big cookie cutter things people do is they invest too much in mutual funds that are ineffective, that often have people too much at risk, with too much volatility, with low yields, and with not the returns that are needed or wanted. And when people are getting not the returns they need or want with a lot of risk and volatility, I would think most people would quickly say, that makes no sense. And if that's you, you probably need to be looking at and reading a book like Michael Eastham's book, Common Sense Income Strategies, which I like that book to help you think about how to be a smart investor. So mutual funds, cookie cutter approaches are one thing, and the other big thing that people do is I'm in an annuity, therefore I'm okay. And I say it that way because you need to understand not all mutual funds are the same, not all annuities are the same, not all advisors are the same, and not all fiduciaries are the same. Who's got the experience? Who has the experience for retirement planning, true retirement planning, which includes income planning, which includes tax planning, which includes estate planning? You need to be focused in on all the different planning areas. If somebody is a product salesman, as I was just talking about in the last segment, and you might not think they're a product salesman, but effectively, if you look back and say, what happened in the process? Or was there even a process? Or was it just a meeting and 1, 2, 3, you talked a little bit and then, okay, we allocate the monies this way. So the problem with mutual funds in retirement is that you don't have 20, 30, 40 years to stay put and ride out the whole thing. You have to understand what investments are going to go the distance for you in retirement that could be easily a much shorter time frame. That might only be 10 years of your life or 20 years. And if it's longer, like I talked about with medicines getting more enhanced and where we have more improvements in the healthcare industry, some of you may need the 30 to 40 year plan. But with the unknown as we get older, and I'm sure many of you people as investors have seen that some people don't have the long life they might have thought they would have had, or you might have thought they had. And maybe, unfortunately, some of you listening in, that might be your case. And so how do we invest intelligently? And what about long-term care and the cost of it? It's one of the biggest factors in retirement, and it's one of the things that can cause a very devastating effect and impact. And again, this is a study that was conducted by a large CPA accounting practice or firm that deals primarily with the wealthy in America. They have about 10,000, and this is a national group, they have about 10,000 clients. So their survey comes from the tax returns that they do. So this is what they have uncovered that their wealthy clients do. So number one, and you probably are not going to believe what I'm about to tell you, the number one place that the wealthy put their money is in cash. Now you're going to say, oh my goodness, Drew, no, they can't make any money. So let me quickly say it's cash where these are high yielding savings accounts. So these, and particularly now and at this time, money markets are getting over 4%. And so you shouldn't just be sitting in a checking or savings account. But the thing about the cash position, and this is the number one place that the wealthy keep their money is, and the reason that they keep it there is not just to keep it in cash, but to keep it there for opportunities. So it's cash for opportunities is number one. Number two is real estate. And because of rental income and appreciation and the tax advantages based upon depreciation. Now, I don't have enough information right now to say too much on this. So I'm going to say pretty much I believe, but I think I'm correct about this. I was doing some reading and some studying, but I believe that with this new big, beautiful bill, that new purchases of real estate may allow one, if the real estate was purchased, I believe, in January of this year and then moving forward, and I'm not sure if I can't imagine it's just this year, but I believe the way it goes is if you invest in real estate rather than you depreciate the asset for X amount of years, typically a long period of time, you can actually escalate the depreciation. And so I don't have all that information, but these are the kind of things you want to know. So some of these bills get passed, and then after they get passed, we have to sort through it. So this is still obviously early on. But okay, let's just review. Number one, cash. Where do the wealthy keep their money or hold their money? Cash for opportunities, number one. Number two, real estate. Could be residential, could be commercial. All right, number three, bonds. What typically are bonds? And I'm talking about individual bonds now, not bond mutual funds. Bonds, government bonds, U.S. Treasuries, or could be municipal bonds, or could be corporate bonds. Number four, stocks. Now, let me say individual stocks or REITs, or real estate investment trusts, can be considered a stock. And, one might even say a BDC, Business Development Corporation. I would say quickly, even though when I was getting this list, somebody didn't say it, but any of these REITs or BDCs that are not tradable, I don't think is what most investors want. I would think you need to make sure that REITs, real estate investment trust, and BDCs are tradable, meaning that they're liquid. Number five is mutual funds and ETFs, but the biggest one, and it was not a surprise to me when I got this study, was S&P index funds. Now, why? As much as on this show I pick on and beat up, so to speak, mutual funds, why would I say, okay, I understand the S&P index funds? Because 80 to 90% of mutual funds underperform the S&P index. So this is not a recommendation, by the way, for any of these things, because we don't know your situation, and I don't know anybody's unless you're a client. But the fact is that this is a show that's an educational show trying to help you understand. But the bottom line is that just knowing that the S&P index has, generally speaking, better returns because it's at least the average. What does it mean, the S&P index? It means the average of the S&P, for a given year, or when you look at it over a 20-year period of time, you can look at some studies like the average yield is only 1.5%. But for growth purposes, the S&P index funds, or, which is mutual funds or exchange traded funds, without getting into that right now, the difference there. But the bottom line is that's the fifth place where the wealthy keep their money. Now, I said the fifth as in this was in order. Remember, first was cash for opportunity. Second was real estate. Third was bonds, individual bonds. Fourth was stocks, but often real estate investment trust. And then fifth, mutual funds or exchange traded funds invested in the S&P index. So, some could be the SPY or DEVO. Those would be a couple that some were mentioned in the study. 6 is commodities. What would those be? Gold, oil, Bitcoin even, and art. So commodities was number 6 on the list. Number 7 was intellectual property. Somebody's writing a book. I'm writing a book. And, there's intellectual property, and that can have a value. There could be some royalties. So many of the wealthy had various different investments. If you had some property, I'll say in Louisiana, that was generating some oil and gas, maybe you have some royalties there as an example. Number 8 is cryptocurrency, mining, staking, and investing. And I could also put in there Bitcoin, but I had Bitcoin in number 6 under commodities. Number 9, collectibles, things like art, cars, watches, etc. Number 10 is building a business, that maybe someday gets sold or there's a public offering, etc. Number 11, tax advantaged accounts such as IRAs, 401ks, 403bs, 457bs, Roth accounts, etc. And number 12 was just the fact that there was some specialized knowledge that generated income. So here was the other thing that generally was suggested by this CPA firm. And I want to say, this is not a recommendation. We're not giving advice. We're not giving advisory services advice. This is an educational show, so you understand. But that it looked like from the study that about 30% were in dividend-producing assets. Here was the balance of most of the portfolios. 30% were in dividend-producing assets. 30% were in REITs, real estate investment trusts. 30% were in managed money. Sometimes it could be even like a Berkshire Hathaway or equivalent. And then 10% in cash or cash equivalents. So, in any case, that was a recommendation by this CPA firm in terms of what they like. Now, I don't like broad brush recommendations. I want to say that quickly. So even though I told you this is just based upon a study that I read about and actually saw a clip on YouTube. The bottom line is, hopefully this gives you a sense about the flexibility you may want to have as this world changes. And so hopefully that helps you out. The bottom line is, think balance, think diversification, think fiduciary. And what is that? It's in your best interest. All right, I'm going to take a quick break before I wrap up the last section. What am I doing? I'm talking about retirement investing success. Part of that is having good knowledge to be able to make an informed decision for you. So it's best for you. It's all about you. Your money, your retirement, your life is the sentiment you want to embrace. That's why the name of this show, Your Money, Your Retirement, Your Life. You need to understand how to invest for retirement success. All right, how to invest for retirement success. All right, stay tuned. I'll be right back. And I'm going to be talking about some things you want to understand with respect to growth and income and how you prioritize what you need to do based upon what should be first and what should be second. All right, I'll be right back.
Your money, your retirement, your life. The focus is income first, growth second, and your goals always.
I only have a few minutes left, but I want to thank you for joining me today, or perhaps you're just joining in at the last minute. You are listening to Your Money, Your Retirement, Your Life. Today, I have been talking about retirement investing success. I've talked about the importance of process and planning over or versus product buying, where you were doing product buying from somebody that was doing product selling. You want to understand the importance of a fiduciary process where you are choosing from the universe of choices, where you have gone through a process that plans for you to meet your goals, your objectives, and your needs. That's what it's all about. It's about you. It's about your money, your retirement, and your life. All right. Thanks for being with me. I'll be with you next weekend for more important information that you don't want to miss that will help you with your money, your retirement, and your life. Thank you. Drew Pelton here.